Hey, what's going on, guys? How you doing? Dave here. Is your business profitable? Do you feel like you could manage your cash flow better? Have you heard of Sequence and have you heard of Ryan Dice? Well, if you've heard of neither, then you've come to the right place. I'm gonna hook you up. We are going to help you master the cash flow of your business, and we're going to automate what Ryan Dice, he's a big business consulting guy, and he owns a portfolio of companies. He has a company called Scalable, and he owns a portfolio of companies that do combined about 200 million. And so he's got a lot of CEOs and businesses underneath his umbrella that answer to him, and they also do some consulting. And what you're looking at here, this is the cash flow waterfall that he advocates using for their businesses. And at the top of this waterfall, you're going to see their operating account and then ways in which that money should be flowing out to fill different buckets, different accounts in a responsible manner to future-proof your operation and to have you prepared for inevitable obligations that are coming down the pipeline. So as you can see, operating accounts on the bottom, sinking funds, acquisition and investments, and even partner distributions is at the bottom. And I'm using an app called getsequence.io. It's called Sequence. And if you go to their website, I'll show you what that looks like real quick. This is their website. You could go to their playground up here at the top and you could dabble on your own. And I could tell you that they've got a pricing strategy for personal and for business. We use the Pro plan, and we actually get money back from Sequence every month because we use this system and debit cards associated with accounts that we've opened with them for purchasing. So it's actually cost us nothing. We've actually made money off of it. And so this is what I'm advocating for you, is to use Sequence and automate the money moves of your business. And so real quick, he's going to give a voiceover on the structure. I'm just going to show you that we have in fact created it already. And so the way this works is you can add an income source. And so an income source, it's a checking account that allows money to come in only. So it's an account that's incoming funds only. And so if somebody else saw that account number and tried to take money out, they wouldn't be able to. So this brings money into Sequence, and then from that, as soon as you receive funds, you can create rules on where it goes. Otherwise, you can link to external banks, and then you can make rules based upon a date. Or if you're moving money from the Sequence map to that bank, you could do it with all kinds of awesome rules. And so, for example, if sales of 5,500, suppose we did 5,500 in revenue last night, and it came in automatically, we could take money right off the top. We could take sales tax, and our sales tax isn't 9.13%. It's actually 8.88, but we're accommodating the jack that the credit card processor takes. And so when the credit card processor takes money, the money that actually hits your account is less than what you actually did in revenue, but your sales tax is still on that total. So this has been adjusted, and I have another video where you can learn about that formula and implement it. We're in New York, it's 8.88 here, and that's what it would be adjusted. The company tax account, like you got to start putting some money aside for taxes because you're going to owe that on the profits of your business. And if you look at your tax returns and talk to your accountant or CFO and find out what that percentage is roughly, then you can start planning for that and create an account. And then this is happening automatically. Those monies are just coming right off the top. And then the remaining money is going into your operating account. And so from that, in this fictitious business, we're saying that we're going to start the month off with 150K. And an emergency fund is going to be 3 times that. So I don't want to get ahead of myself. Let's let Ryan talk it up a bit, and I'll pause him a couple times and show you the automations and philosophy that I have associated with what he's advocating. But this is going to take your business to a whole nother level. It's going to free up bandwidth for you and your finance, your accounting team. It's going to have precision and clarity, and you're going to love it.
In this video, I'm going to show you how to install a cash flow waterfall in your business that maximizes your personal distributions while still leaving enough cash in the business for growth. I'll tell you how much you should leave in savings, how much you should leave in operations, the different bank accounts that you'll need, and I'll even drop a link to the same tool that my clients and portfolio companies use to manage their own company's cash flow. Number one is you need to act broke. In other words, we don't want to build up too much surplus in your business checking account. If you do that, Parkinson's law. Now, Parkinson's law states that work will expand to fill the time available for its completion. You probably stick. Entrepreneurs' ability to spend will always outpace their ability to earn. And you probably have experienced this. I know I have. When there's a lot of money in the bank, I can always find people to hire. I can always find expensive software to buy. I can always find, probably unnecessary perks to offer to the team, which is why it's important that we bake in profitability ahead of time. We'll talk more about that. Core principle number 2 is you need to plan for rain. And by rain, I mean emergencies. We need some kind of emergency fund. And emergencies, this isn't just being negative, right? It's not being kind of a negative. You need to fill the buckets. And we're going to talk about what those buckets are, but it's really important that you tell your money where to go. So we want to make sure that we've got funds that are in our operating account. And then once we have enough funds in our operating account, those funds should then flow into another account and then another account. The analogy that we use, if you've ever been to a wedding and you've seen one of those champagne glass pyramids, right? You've seen it where they start pouring it in the top and then it overflows one glass and it flows into the next and the next and the next. This isn't if this expense is going to be there. It is going to be there. So it makes sense that as we have available cash, that maybe we should put some of that money in what's known as a sinking fund so that we can fund those future investments. Now, in addition to that, probably one of the most important accounts that you need to be doing is your own bank account. We need to be making distribution. So to still saving for emergencies. So at this point, if you want to move beyond 3 months in that emergency account, my advice to you and my advice to all of our clients and portfolio company CEOs who feel like, I feel like we should have a bit more than 3 months, operating expenses in the emergency fund, is to go 50-50. What that means is the operating account is full. It's now going to dump into the emergency fund, but the emergency fund, you got 3 months in there. Rather than keeping all the funds in there until you get to 6 months, go 50-50. Okay, and say we're going to leave 50% in the emergency fund to slowly build to 6 months or whatever your number is. The other 50%, though, we want to flow over into available cash to either fund future sinking funds, acquisitions, or investments if needed, or heck, paying yourself a distribution. And if you go and look at the cash flow waterfall worksheet, you can see here we've got 2 different emergency fund levels. If you want to have emergency fund level 1, which would be that 3-month. If you want to have emergency fund level 2, again, wouldn't recommend up to 6 months, but if you want to have different levels and if you want to have a percentage offset, we've accounted for that as well. And then everything over and above that, you can build different target percentages based on how quickly you want to fill any of the other accounts that you have. So in this example, this particular business, they've got an annual event fund that they want to make sure they save for. They've got a building fund because they want to, move, stop leasing and actually purchase a building. They've got a company retreat fund and they've got some additional like retained earnings that they want to set aside for possible future like unknown, investment. Now, some other examples of sinking funds.
And so we've set up those as well. So you can see that we've got the building fund and you can see that we use the exact percentages that he had outlined there. Your percentages may vary, but just to kind of show the practicality of it. And this is the way it would look, by the way, if you hadn't allocated all the monies from the savings account and we wanted to add that 10% for buildings, it's automatically going to populate you with what's left in that account to be transferred. And then you just adjust that down to 10%. And then we would call this the building fund, right? Building fund, there it is. Click on it. And as you go to add accounts that you'd like to distribute monies to, it'll only show you the remaining accounts that you haven't already opted to allocate funds towards. And so that's helpful. And it's always going to give you the remaining percentage so you don't try to accidentally transfer 101% of what's available. So this is a fantastic tool for this purpose. And what I like thinking about when he's going through his explanation of where everything's going is kind of like, let's anticipate and let's automate. If we can anticipate it, let's automate it so we don't have to think about it. He said, act broke. You're only going to be giving yourself in your main operating account what the business needs to operate. All of your fixed costs, all of your payroll, all of your prime costs, payroll, cost of goods, all of your variable expenses, all of them are put into, and you should have a rolling average number for the month, and especially for where you are, taking into account seasonality. And from that, anything that overflows from that is going to start funding our little champagne waterfall or our money map. money map.
Let's say you want to run a marketing or an
waterfall.
advertising campaign test. I know we've done this a number of times. You know, we heard about this other idea that worked really well, but we don't know. So rather than pulling from your existing marketing budget, maybe you say, let's have a test account. And so you want to create a test account, a separate one. Annual events, which I mentioned, a biggie. This is a big, big biggie. Holiday and end of year bonuses. Most of the entrepreneurs that I know pay some type of holiday or end of year bonus, but they forget about it until December. Look, there's no question about when the end of year is going to be. It's only always December 31st. So if you're going to pay some type of holiday bonus, Christmas bonus, end of the year bonus, don't be shocked when the end of the year or the holidays turn up at December, because it's going to happen every freaking year. Plan for it, save for it, set up a special account for it, budget into it. Another big one would be like company retreats. I know a lot of sales-driven organizations that they offer big, president, retreats for their top sales reps and things like that. Again, if you have a known expense that you're budgeting for, don't just budget for it, save for it. Create the accounts, set aside, let the money that is overflowing from the other buckets into these other funds so that when the expenses arrive, the cash is already there to pay it. The next step, we want to bank the profits. And I'm a big, big, big believer in having a separate account that is your distribution fund. You're basically saying we are putting money in this account and it is available for distribution. The plan is to distribute this amount. And what I love so much about the cash flow waterfall worksheet is it will tell you exactly how much is available to go into your distribution fund and how much are you accumulating in that particular fund.
And so what I would say is that Ryan probably doesn't know about Sequence yet, but he will soon. And the money that you have, instead of this having to revert to a spreadsheet or to QuickBooks or to whatever financial software you're looking at, and then removing monies that you've set aside to actually get to what your actual number is, you could just log into Sequence if you're an authorized user, and you could just see it. As soon as you connect Sequence to your financial software of choice, it will automatically show you all of these as separate checking accounts. For my family, for my household, we have 15 checking accounts. Some people might think that's crazy. I now think it's crazy to have less than 5 checking accounts. I want something. If there's a budget that we need to manage or something we slowly need to be saving money towards, I want to open an account to it and be able to see it. I want to be able to have tangible progress, and I don't want that number to get muddied up with operations or get muddied up with CapEx or emergency money, or in my household, is that money that we can go out to eat with? That's our big crux in our house. But for this purpose, now you're going to have an added level of structure and accountability so that money is more likely to flow down to the partner distributions.
This company in this month. And I don't just, look at that and do that because I want to make more money, which, let's be honest, I do, and hopefully so do you. I look at it because it's the ultimate sign of a healthy business. If a business every single month doesn't have any money available for distributions, if everything's going right back into the business, then I got to ask, why are we doing this thing? Now, there's obviously going to be times when you're going to double down. You're going to want to say, no. For right now, we're going to be doubling down on growth. But if that's the only thing that you ever do, if the money never comes out, then I submit to you, you're not running a fully efficient and effective business, because the goal of every business is to distribute excess profits to the stakeholders.
That's it. Distribute money to the stakeholders. That's it. So this will help you do it. I highly recommend you guys look into this, both for business and for personal, and you could create separate maps to do them. And if you're a small business owner and business flows into personal, I've definitely helped out in scenarios where several business accounts had to be on the same money map as the personal map, or personal money map part of the tree. And there's a way to make it all work and make it all clean and fluid. So you can automate the smart money moves of your business. Just if you take anything away from this video, Dave's your guy when it comes to Sequence. And anticipate and then automate. You want to save, you can anticipate it, you can automate it, and if it needs to be small nibbles on a weekly, bi-weekly, monthly basis, so be it. Like, subscribe. Dave's your boy. Next week, or in the coming weeks, because this editing of this video was a nightmare for me. I suck at this. I'm going to do a personal finance guru who has some couple and kind of tears them to pieces and then tries to get them to a new place with their finances. So that'll be my next video. Cheers, guys. Hope you're all is well. GetSequence.io. I got a newsletter down below. Give me a like. Give me a subscribe. Holler at your boy. I love comments. I love comments. Give me some comments.